Hello, this is me June from Mitchell University. November 7th, let's start Big Juicem News. Welcome to Mijun, where we remain committed to the fundamentals of United States stock investing. It's already Friday. Every time Friday comes around, I often find myself thinking, I hope the stock prices go up today. I remember when I was a beginner investor, if the stock prices fell on Friday, I used to feel a bit down over the weekend. So every Friday, I hope that the United States stock market will do well, so that those of you investing with me can enjoy your weekend in a good mood. That's the wish I have every Friday. Since the United States stock market dropped yesterday, there's a higher chance it will rebound today. These days, there's a lot of investment capital that's outside of the United States market. Anyway, I hope the United States stock market shows some strength this Friday as well. Let's begin today's Big Juicem News for November 7th. For your information, I don't have much time today, so I think I'll be giving you a very short video. When I look at other YouTube channels, there are a lot of short videos that are only 20 or 30 minutes long. Just for today, even if I send you a shorter video, I hope you'll understand. But even in the midst of this busy schedule, I think I should read some of the comments you've left. Recently, it seems like you really enjoy when I read your comments and share information or answer your questions. The first comment is from someone with the username Hangkong. Thank you for the video today as well. I've been watching quietly for a long time, but today I suddenly noticed Miju's short-sleeve t-shirt and her tanned, bronze skin, so I decided to leave a comment. You look healthy, so it's nice to see. A lot of people are leaving questions about cash allocation, so I'd like to share one of my own questions about cash allocation as well. Since my seed money is too small, I feel like keeping 20% in cash means missing out on investment opportunities, so this year I've just been investing 100%. I've been accepting minor adjustments and getting through them well, but I still think it would be more beneficial to keep even 10% in cash and invest during corrections. Thank you always for your great videos. Actually, the reason I keep some cash on hand isn't because I want to maximize returns by buying at low prices when the stock price drops. Well, that could be the case. The way I see it, whether you just hold on to your stocks or keep some cash and buy when the stock price drops, I think it's pretty much the same thing. In many cases, people end up buying back at a higher price than they sold for. We can't predict the future of stock prices, and among United States growth stocks, there are many that rise really sharply. It's correct to assume that timing the market like this is impossible. Now then, some of you might be wondering why I'm still holding as much as 20% in cash. That's because I'm investing for the long term. There are various strategies we can use to maximize our investment returns. Some people try to find what we often call a 10-bagger in the short term. A 10-bagger is a stock that increases more than tenfold in price. So, although it's a bit risky, there are quite a few people who are willing to take that risk and search for 10-baggers that can go up more than tenfold in just 1 or 2 years. So there are people who prefer companies that are heavily in debt, but only have a story about growth. But I have a lot of memories of getting burned in the past by investing that way. So from now on, I need to get my act together and invest in a way that suits me. I'm already in my 50s, so I realized I shouldn't invest like I did in my 20s or 30s. While I pursue safety and occasionally hit a 10-bagger, I'm making one bet that's even more important than that. What is that? It's time. I told you that you were overvalued. I've explained this once before. I believe that for investors, the most important thing isn't actually picking stocks, but rather how much time you can secure. I think success or failure depends on this. What I mean by that is, let's say we were lucky enough to catch a real 10-bagger. Let's just assume that. But if you didn't go all in on one stock and instead bought several growth stocks, risky ones, and all the others dropped except for one that went up 10 times, or maybe only 2 stocks became 10-baggers in that case. In reality, your return is usually only a few times higher, not a 10-bagger. But let's say we pursue stability and, for example, invest in an exchange-traded fund. If you invest in an exchange-traded fund, QQQ is a representative example with an average annual return of about 14%. That's been the case for the past 5, 10, even 15 years. So if you can achieve a 14% return every year for a long time, let me show you the results you can get. Now, here I've opened something called a compound annual growth rate calculator. Compound annual growth rate stands for compound annual growth rate. The word compound refers to compound interest, indicating your average annual return with it. I've entered 14% here. This assumes you're investing in QQQ. Now, if you set the investment period to 20 years, as you can see here, let's say your investment capital is 100 million won. I put in 100 million won, and you don't have to make any additional investments for 20 years. Your investment capital can remain at 100 million won without further increase. A 14% average annual return over 20 years turns 100 million won into 1.374 billion won. So that's a 13-fold increase. Now, the question is whether it's easier to find a 10-bagger or to steadily invest like this for 20 years. And what's important here is that the risk is very low. When you look at the historical average statistics, earning an average return of 14% over 20 years is definitely possible if you invest in tech stocks. And anyone can achieve a 10-bagger if they just have 20 years. That's how we can calculate it. Now, what's important here is that you don't leave the market for 20 years, and during that time, there will be many bear markets. There will be economic recessions, cycles of rising interest rates, wars, and even pandemics. It's a very challenging process. In my opinion, the ones who survive this process are those who at least reduce their risks and prepare some extra cash. That's why I always keep close to 20% of my assets in cash. It's a way to prepare so that I can keep investing steadily for 20 years without pulling out. So I'm securing a safe place for my assets. That's how I'd like to explain it. Han Kong, I hope my answer to your question was helpful. We're a bit short on time today, but I'll read one more comment. This time it's a valuable message left by someone using the identification writ moment. Miju, it's been 8 months since I began investing in stocks. Before that, I felt no joy or progress in life and spent my days depressed and lethargic, unsure what to do. It was hard to go to work, and I was always worried about what I should do. While I was struggling, I got to know you, Miju, and you have no idea how grateful I am. Every time you post something, my heart beats faster. You've brought energy into my life and helped me make progress, even if just a little. I'm very grateful to have met you. From now on, I'll keep trying to improve, and I'll live with the hope that today will be better than yesterday, and tomorrow will be better than today. Let's go! I think you probably signed up for the Mijun paid membership. You said that every time I post something, your heart beats fast. Every time I read comments like this, I think, I really should post at least one more thing on the membership. Thank you for giving me so much motivation. Now, there's one more thing I'd like to mention. You've written here a saying that I really like. The hope that today will be better than yesterday and tomorrow will be better than today. Now, as we enter our 50s and 60s, we find ourselves entering the declining phase of life in many ways. I call this the downhill path. Many people study and encourage each other about the uphill path, cheering each other on because it's tough, but the truth is there isn't much mention about the downhill path. Everyone eventually faces a downhill path in life. You work at a job and then eventually retire, and then you have to give up your business card. Your social status disappears. In your 50s, your body begins to break down. You experience more aches and pains, and your physical abilities decrease. When life starts to go downhill like this, and many of the networks that used to support you are cut off, you start to feel very alone. Then life can become dull, stagnant, and very boring. That's why I think investing in United States stocks is a really good pastime. Earlier, I showed you the compound annual growth rate calculator. Our target rate of return is 20%, but it's okay if we don't reach 20%. For example, even if we only get 10%, let's say we're investing in the S&P 500. Now, even if we can only make a 10% return if we invest for 5 years, 10 million won will grow to 16 million won. With a 10-year investment, 100 million won grows to 259 million won. Over 20 years, it becomes 670 million won. If you invest for 30 years, 100 million won can grow to over 1.7 billion won. So what this means is today is better than yesterday and tomorrow will be better than today. So if you consistently invest in steadily rising United States stocks like this, I personally believe that you can feel satisfied by seeing yourself continue to grow even in the second half of your life. So I also want to say that investing in United States stocks is essential for a satisfying and happy new life. I would like to sincerely thank Riti Moment once again for leaving such an honest comment. Today as well, let's briefly check the United States stock market situation from yesterday before we move on. Yesterday, about half was red and now half is green, but most of the red is concentrated in tech stocks. So since most of the large cap stocks showed a sharp decline, overall the movement of the index was not good. If you actually look at the breadth of the market, there isn't much change. Currently, the percentage of stocks with a good short-term trend is 41.35%, and the percentage of stocks with a good long-term trend is 51.8%, so it's still above 50%. If this percentage keeps dropping, that's a very bad sign. Well, I've emphasized this several times. Next is the Volatility Index. Unfortunately, the Volatility Index has risen to 19.5. When that happens, the 201 moving average is now at 19.36, so the 201 moving average has moved up. It hasn't surpassed the historical average of 20 yet, but if the Volatility Index goes over 20 and continues to stay above the 21 moving average, we can interpret that as a possibility of a short-term correction coming for the time being. Currently, the Fear and Greed Index is still stuck in extreme fear. In this regard, if an additional correction occurs and extreme fear spreads, it could be seen as a dramatic opportunity, as I mentioned. So for today, since I think some of you might be feeling nervous in the current situation, I'll share how I assess the situation and what my additional buying plans are. I'll reveal my personal plan to you all. United States stocks have fallen again. The article above presents various pieces of information, and among them it says this. Recently, due to the government shutdown, Trump tariffs, and Supreme Court rulings, the uncertainty in the United States stock market has greatly increased. So, there are a lot of uncertain factors, and you can see it as having many pending issues that we're waiting for the results of. That's why volatility, which had been very calm in recent months, is now increasing. We check the volatility index every day, so we know it well. For the past 6 months, the volatility index has been very calm, and usually such a quiet market tends to show an upward trend. But recently, as volatility has become extreme, the volatility index has broken above the 200-day moving average again. But from my perspective, negative sentiment is overwhelmingly dominant in the current United States stock market. So personally, a bear market refers to a drop of more than 20% in stock indices, right? Of course, there are bear markets, but there are also official corrections where the S&P 500 falls more than 10%. I think it's not easy for that to happen. There are two types of market drops, a bear market, which is over 20%, and a correction. A 9% drop isn't considered a correction. This is just the stock price taking a short break. If it drops more than 10%, but not more than 20%, we officially call this a correction. What happened last April was a correction. But what I'm saying now is the sentiment is still very negative, and there are so many things to worry about. When there are this many concerns, I expect that even a correction won't happen easily. Of course, my prediction could be wrong. To put it another way, there are still quite a few investors suffering from fear of missing out. That means there are too many investors holding cash and just waiting for the stock prices to drop. So when these investors put their money back into stocks, I'm saying that it's easy for the falling stock prices to recover. And now I'm going to explain the chart. As I mentioned in the broadcast 2 days ago, The first buying opportunity is when the stock price drops to the 21-day moving average. In fact, I made my first purchase at that time. Then, after the stock price rebounded briefly, it fell again yesterday. The 21-day moving average broke downward, which could push the stock price even lower. Now, the next support line is the blue line. I think the blue line is at 6,665. This is the 51-day moving average, and so far, the 51-day moving average has never been broken. Since April, whenever it looked like it might fall, it has always bounced back at this 51-day moving average. If the stock price nears the 51-day moving average, I see that as a second buying opportunity. You can add more stock. That's the approach you should take. But if the 51-day moving average is broken, that means the midterm trend is also weakening. That's how you can see it. Then, where could it go next? It's here, if you look here. Last time there was a major bearish candlestick, the stock appeared to bottom here. I'll show you the amount. It's 6,545. I'm planning my third buy near the horizontal support at 6,545. That's my approach. Although it's unlikely, if the S&P 500 drops over 10% and a correction occurs, the green line will then serve as support. The green line and previous high meet at this point. So please take note of this area right here. On Thursday, it was revealed that annualized sales are expected to exceed $20 billion, and that open artificial intelligence's sales could surge to hundreds of billions of dollars within the next few years. That means artificial intelligence is still just getting started. They've already surpassed $20 billion in sales. That's extremely important. So, sales are currently showing a sharp upward trend. In a few years, that $20 billion could grow to hundreds of billions, with some saying it could multiply several or even dozens of times. Altman posted a message on X. Here's what he said. We expect to close out this year with an annualized revenue of over $20 billion, and by 2030, our revenue will grow to hundreds of billions of dollars. And here's a surprising number. We're reviewing $1.4 trillion in project commitments over the next 8 years, according to reports. Of course, to achieve this, continuous revenue growth is necessary, and we need to double our growth several times. However, they emphasize that they are optimistic about that possibility. What does this mean? Over the next 8 years, a company generating $20 billion is reviewing contracts totaling $1.4 trillion. That's what they're doing. So their sales have to steadily double or triple every year, and they're saying they're optimistic about that. We're about to launch an enterprise app, and we expect it to be a very important growth engine for consumer devices and the robotics sector as well. They're saying that in the future, as enterprise software used by companies and devices or robots used by consumers emerge, open artificial intelligence is products will sell like hotcakes. And Altman also says that new industrial sectors requiring artificial intelligence are emerging. To provide specific figures on this part, OpenAI is also considering selling directly to other companies or individuals. They also hinted at the possibility of raising additional funds in the future. All the data we are seeing now shows that much more computing power will be needed than what the world is currently planning for. He made a very important point. And also, if you look here, Altman recently announced that OpenAI has formed large-scale partnerships with major companies like NVIDIA, Advanced Micro Devices, and Oracle. He said that all these investments are part of a long-term strategy to build artificial intelligence-centered future infrastructure. According to him, large-scale infrastructure projects like this take a long time to complete, so we need to start right now. Otherwise, it will be too late. Given the rapid rise in artificial intelligence use, the risk of depleting computing resources is more real and serious than oversupply, he said. So if we don't invest now, there's a very high possibility that we'll run short of computing power and computing resources. Due to computing constraints, we must limit certain functions or models. We're still saying we can't sell due to limited computing power. And also, although artificial intelligence uses massive computing power, if it can provide humanity with important scientific breakthroughs in return, we need to start preparing for that moment now. And he concludes by saying that future is no longer a distant future. I organized some of my thoughts after reading this article. Many so-called experts are currently warning about an artificial intelligence bubble in the market. Recently, the United States stock market and the Nasdaq have been very volatile, and one of the main reasons for that is the theory about an artificial intelligence bubble. Listening closely to these experts, it all leads to one conclusion. There's a huge amount of investment going into artificial intelligence, but they say there aren't many real cases showing tangible results that could justify this continued investment. To put it simply, it means there's no return on investment, or the return on investment is low. That's how you can sum up their argument. Now, in that context, Open Artificial Intelligence is a representative application company that's investing astronomical amounts of money in artificial intelligence. According to the article above, Open Artificial Intelligence's revenue is increasing exponentially. That's what we can see. Therefore, for investors like me who are building a portfolio focused on artificial intelligence beneficiary stocks, this was encouraging news. That's one way to see it. Now, Sam Altman made a very important point. Looking at the current trend where artificial intelligence usage is rapidly increasing, he said that the risk of running out of computing resources is much more real and serious than the threat of oversupply. So, from my perspective, how can we analyze and use this statement from an investor's point of view? First of all, Sam Altman he says that the fields with the highest chance of success are picks and shovels. That's how I interpret it. Because the most important message is that the demand for artificial intelligence services is exploding, but the computing power to support it, in other words, the infrastructure, is seriously lacking. That's the key point. Now, that means in this artificial intelligence gold rush, instead of the people mining for gold, which are the artificial intelligence service companies and application companies, companies providing computing infrastructure, essentially selling picks and shovels, are much more likely to succeed. That's the takeaway. So from an investor's perspective, this can be interpreted as a strong buy signal in these fields. The first is hardware. These are companies that sell things like GPUs, networks, servers, and cooling systems. We're talking about companies such as NVIDIA, Advanced Micro Devices Broadcom, Credo Technology, and Celestica. Now, these companies are essential hardware manufacturers for training and running artificial intelligence models. Right now, demand is exploding, but supply is limited. That's what I'm saying. These hardware companies gain pricing power, which is also called price-setting power, and there's a high chance that their margins will be maintained or even increase because they can keep raising prices. In addition, they can secure long-term order visibility. Right now, the growth rate is good, and if they can maintain that growth rate going forward, the stock price can keep rising. Now, the second beneficiary sector is cloud service providers. What about cloud service providers? They use their massive capital to secure chips first, and these are companies that lend out artificial intelligence computing power. For example, Microsoft with Azure, Amazon, the top cloud company with Amazon Web Services, Google, and Oracle. These companies are likely to benefit. Now, lastly, data center and power companies, because as we all know, artificial intelligence consumes a huge amount of electricity. Therefore, power companies such as Talon Energy and Vistra are also seen as long-term winners. You can see it this way. Now, on the other hand, there are some sectors that could benefit, but there's also a chance of failure. Fields where success and failure are clearly divided. These are the people who mine gold, the gold miners, according to Altman. He said that due to computing limitations, they are also restricting product features. They're saying they can't judge without it. That's the meaning. For application companies that use artificial intelligence to create real services, this has two meanings. The first is that the burden of costs can increase significantly. Artificial intelligence services incur infrastructure costs, including GPU and cloud usage fees. These prices could become astronomically expensive because prices are determined by the law of supply and demand anyway. You need to remember this part. There are now countless artificial intelligence startups and service companies. They can only survive if their revenue model covers and exceeds the high costs. That's why, statistically, the chances of investment success are inevitably a bit lower compared to infrastructure companies. That's what I can tell you. So, from an investor's perspective, when it comes to investing in artificial intelligence beneficiaries, it's essential to distinguish the good from the bad. Just because something is labeled as artificial intelligence doesn't mean success is guaranteed. On the contrary, many companies may fail because they can't handle the massive infrastructure costs, so it's really important to carefully select application companies. That's the conclusion I'd like to make. All right, let's wrap up with Ji-Hoon Mi's conclusion. What about Sam Altman's remarks? He said that the pie of the artificial intelligence industry itself is becoming much bigger than we think, bigger than we can even imagine. So, I would like to say that this is a very important statement, as the top executive in the industry once again reaffirmed the opportunities of artificial intelligence. So, from an investor's perspective, I think it's reasonable to interpret this statement as meaning that the chances of success are high for focused investments in artificial intelligence beneficiary stocks. However, the fields that can truly reap the fruits of that success are not the companies that create artificial intelligence services. That is, not the application companies. It's a good opportunity to remind ourselves once again that it's actually the infrastructure companies which supply the essential resources, namely computing power, to them. I'll wrap up with that point. The final content for today is the United States stock video. Topney is today's main character in the United States stock video. Recently, as the market volatility has become extremely severe, especially cryptocurrencies are fluctuating a lot, I think it would be good to hear Topney's outlook on this. That's all for today's United States stock news. We would like to thank everyone who invested in the United States stock market with Mijung this week as well. We hope you have an enjoyable and productive weekend ahead. I will greet you again next week with plenty of useful content to help you with your investment activities. Let's all keep fighting together until the day we all retire through investing in United States stocks. Have a happy day. Thank you.
Thank you. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you. The Zoom by DC.
Today,
Both Bitcoin and the broader cryptocurrency market saw a slight rebound. However, as Katie Stockton from Fairlead pointed out yesterday, Bitcoin fell below its 201-day moving average. I know you are closely watching the technical indicators. What is your perspective on this?
yes, I think it's natural to closely watch Bitcoin's technical indicators. Bitcoin is sensitive to market liquidity, investors' risk appetite, risk perception, and premium awareness. In recent weeks, there have been several headwinds. Examples include the possibility of a government shutdown, last month's hawkish rate cut decision by the Fed, and uncertainty about December. Concerns over a shutdown and Treasury liquidity are also affecting the situation. The Treasury is increasing cash in its general account, the Treasury general account. All these factors have created a chain reaction of pressure, putting a burden on the cryptocurrency market. I think if these issues are resolved, the headwinds could turn into tailwinds.
That's right. We should address that point. The part we haven't discussed enough is the funding stress that appeared in the SOFER secured overnight rate. According to the data released last Monday, the SOFER rate dropped sharply on Halloween compared to the previous day. This sharp drop may signal broader market liquidity issues. Should we monitor this more closely across asset classes?
People are definitely paying attention to that part. As you know, this kind of phenomenon is often interpreted as an early sign of market stress. In this case, it appears to have happened alongside window dressing, short-term position changes by banks to improve their end-of-month financial statements. We are monitoring the situation, but funding stress appears to have already eased. Also, its impact has not spread to the credit market or bank stocks. Therefore, this phenomenon appears to be a temporary outlier and is likely related to the government shutdown issue. However, it is definitely an indicator worth keeping an eye on.
This is a deleveraging phenomenon that occurred with Bitcoin. Based on which indicators or trends can we determine that this phenomenon has been completely resolved? That's a good question. Do you think this situation is unfolding like similar events in past markets?
To some extent, yes. To understand this situation, we need to look back at two specific periods. Those periods are the collapse of FTX in 2022 and the COVID shock in 2020. During both periods, there was very widespread deleveraging across the entire cryptocurrency market. The crypto market is usually structured with quite a high level of leverage. The deleveraging that happened on October 10th this time was the largest in history. The aftermath continues even after 2 weeks. For example, the decentralized finance protocol Stream R reported significant losses, which also triggered a chain reaction. Yesterday's balancer hack intensified market anxiety amid the ongoing situation. Therefore, it seems it will take a few more weeks for the market to stabilize. The good news is that there are still very few hidden large-scale insolvencies surfacing as major issues. There are no indications this will become a systemic risk. However, it will take time for investor confidence to recover, and that's why cryptocurrencies have taken a big hit in recent weeks.
Let's take a look at what this Bitcoin correction means for the stock market, especially the NASDAQ 100 Exchange Traded Fund or the NASDAQ 100 Index. Recently, these two have shown a strong correlation.
Yes, and that correlation is getting even stronger. As you know, market makers actually trade both markets, Bitcoin and stocks. One of the reasons investors are feeling uneasy is because the stock market has been rising for 6 consecutive months. In early October, the market wobbled for a while, but eventually regained its stability. So I think that's why investors are thinking this way for now. The government shutdown issue continues, stocks have risen 6 straight months, and the market is overbought. The market is a bit nervous. If this trend is just a temporary fluctuation in the first half of November, historically, it's actually a positive pattern. Looking at about 100 years of data since 1928, after the market has risen for 6 consecutive months, there has been additional growth in 5 out of 6 cases. The average increase rate was 3%. In the remaining case, which was in 1942, the market was flat. So to sum up, November is likely to end either flat or strong. The very fact that it has risen for 10 consecutive months is actually a good sign.
Considering that the recent market focus has been on excessive valuations, especially the overvaluation of artificial intelligence-related stocks, is it possible that this trend might become somewhat more dispersed toward the end of the year?
You're right. Institutional investors now focus on 2026. They're planning their position for 2026. I think valuations for the Magnificent Seven and artificial intelligence stocks remain reasonable. These companies continue double-digit growth, and even the notable Nvidia has a PE ratio of just 29. In other words, the market is not demanding an excessive premium. Many stocks have performed very poorly over the past 3 years, with some seeing underperformance not seen in 50 years. So some investors might consider the idea of mean reversion, that is, a strategy of buying stocks that have lagged too much in hopes of a rebound. However, I still think it makes sense to maintain an artificial intelligence-centered position. Growth visibility is high, and companies are now clearly generating profits from artificial intelligence investments. I believe the best strategy for the rest of the year is to focus on core artificial intelligence growth stocks instead of diversifying.
Shoes. Let's walk together on this beautiful downhill road. With happy investor Miju until the day we all boldly retire with national pension together.